practicing in an office since 2008. And I've been teaching this concept since 2012. Prior to the pandemic, I was traveling around. I was probably speaking at 50 to 70 live events a year prior to the pandemic. And then everything after the pandemic came, it all went to Zoom and virtual. So I did that. And now the live events are coming back. So we're back on stage. And again, as Sarah said, that's how she met me. She heard me speaking last year at an event that I did at San Francisco for a bunch of real estate investors. But anyway, I first heard about this concept in 2006. And I was like, man, that sounds really, really good, but it just seems too good to be true, right? Have you ever seen something like that where it looks good, but it seems too good to be true? Well, that was me back in 2006. So I heard this information and I actually bought this book here called Becoming Your Own Banker by R. Nelson Nash. And again, as I said, that's my mentor. And I brought that book home and I didn't do anything with the book. I put it on the shelf. Well, I go back to another seminar about 2 years later in 2008. Well, about 10 or 12 of my colleagues that were at that previous seminar are now at this seminar. Now, the only difference between them and me is they actually implemented this concept that they first heard about it where I didn't. So they were going on and on. They were like, Brent, isn't that banking concept the most awesome thing ever to build wealth, pay off debt, recycle, recapture money? They were going on and on and on about this, right? And I thought to myself, there has to be something to this, right? There's no way 10 or 12 of my colleagues are lying to me. Maybe one or two, but not 10 or 12. So I go home and I tell my wife, now this was in February of 2008. And I go home and I tell my wife, I said, honey, we have to start implementing this concept in our life. And at that time, I was $984,711 in debt. That's what I owed to the third-party creditors. Now, you're probably thinking, well, how does a guy from Kansas get to be almost $1 million in debt, right? Now, I know if you live in a place like California, especially like San Francisco, that buys you a very small house. But in Kansas, it buys you a lot of stuff, yeah? Well, here's how I was in that debt. I had my student loans from chiropractic college. I had the house that I lived in. I also had a house on the Lake of the Ozarks between St. Louis and Kansas City. And if you have a house on the lake, guess what you have to have? You have to have a boat and a wave runner, right? Yeah, I mean, right? Yeah, so there's no way that you can have a house on the lake without a boat and a wave runner. I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to apply this concept that I'm going to share with you, and I was able to pay that debt off in 39 months, 3 years and 3 months. I never had to change my cash flow. I didn't have to work any harder, take any additional risk, or lose control of my money. All I did was added one simple step, and that's what I'm going to share with you today. So I want you to keep an open mind as I go through this. Keep an open mind. I'm not here to ask you to buy anything. I'm not here to sell you anything. As I said earlier, if this is something you like and you think you want to implement it in your life, hopefully you'll do it with here at the Money Multiplier. Now, let me go back to that book that you see on your screen, Becoming Your Own Banker. This is a book, ladies and gentlemen, boys and girls, that you want to purchase and add to your wealth building library. I'm not here to sell you a book, even though if you go to our website, you can order a book. But again, just go to Amazon or wherever you buy your books from and order this book, Becoming Your Own Banker. This book completely changed my financial life. And if you're like me and you have a little ADD going on and maybe you don't like to read, you can also purchase a couple hours of audio that go along with the book. Now, I am going to offer everybody on here a gift. I wrote a book with a guy named Chris Naugle. Now, some of you may know Chris Naugle, some of you may not. So Chris Naugle, and again, if you don't, go to chrisnaugle.com and see what Chris is all about. But Chris and I wrote a book called Mapping Out the Millionaire Mystery. Now, Chris was very big in the real estate space. He's had a couple shows on TV, one on House Hunters, another one on HGTV called Risky Builders. And So Chris is a great person to follow. So again, go to Chris Naugle. He does a live Wealth Wednesday webinar every Wednesday at 1 p.m. Eastern time. He does another segment called Ask Me Anything. You want to follow Chris and watch what he's doing. But on this book that Chris and I wrote a few years back, all you have to do is send me an email, Brent at themoneymultiplier.com, Brent at themoneymultiplier.com, and I will email you the e-version of this book. If you want to buy it, you can buy the book too. As a matter of fact, there's nothing we charge for it. You just pay for the shipping and handling if you want a hard copy. You don't need a hard copy though. And if for some reason you're saying, I don't want to give you an email, Brent, go to our website, themoneymultiplier.com, click on some buttons, and you'll see where you can download the book on your own. Okay, now just to be totally clear of what I'm going to be talking about for about the next 40 minutes, money. Okay, we're going to be talking about money. Now, the thing I'm going to do is I'm going to show you how to build, keep, and create wealth through your own debts and expenses that you already have. Now, this concept that I'm teaching you, ladies and gentlemen, boys and girls, it is not brand new. No, no, no. It's been around for over 200 years. As a matter of fact, if you go back and you look at the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, and you research how they built, kept, and created wealth, this is the concept that they've used. Go out there and do some research on Walt Disney and how Walt Disney built Disneyland, how Ray Kroc funded McDonald's, how Pampered Chef got started before Warren Buffett purchased Pampered Chef. This is the concept that the wealthy are using, but most of us don't know about it because it's too complicated and nobody's explaining it. So I'm going to try to put it in simple terms. Now, when I say recycle and recapture and get all the money back, before I end today, I'm going to show you how to get all the money back on all the cars you're going to buy, drive, and own for the rest of your life. And I know what you're thinking. You're thinking, get all the money back for my cars. What does that even mean? Well, look, I don't even know most of you on this call, but I know how you buy a car. You buy a car one of three ways. You either pay cash for the car, you bank finance the car, or lease the car, right? Because I know you guys are all honest and you didn't steal the car. Well, a couple of you kind of look a little shady, but I'm just going to assume that you guys did not steal the car, right? But here's what you do. No matter how you purchase that car, you got to take your money, you have to give it to the car dealer, and the car dealer gives you the car. So they get the money, you get the car, the transaction is over, everybody goes home happy. But how about if there's a way that you can add one step in your financial life, and not only do you buy the car, so yes, you still give the car dealer the money, they give you the car, but by adding that one step, you're able to recycle and recapture that money and keep that money in the family. Would that be pretty cool? And if you could do that with a car, guess what else you could do it with? Anything at all that you purchase. Now, I'm not going to be able to show you everything. Here's a little homework. I want you to go to YouTube. Go to YouTube and I want you to click in the backward bicycle. And this is a video that's about 8 minutes long. I want you to watch this video. After you watch it, you'll know why I want you to watch it. Here's how it starts.
Hey, it's me, Destin. Welcome back to Smarter Every Day.
Okay. Again, YouTube, the backward bicycle. Now, there's a guy named Will Rogers, and here's what Will Rogers says. He says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So a lot of the things that we've have been taught about money are not actually the truth. So I'm going to challenge you on the way that you're thinking about money. And I want you to challenge us back by putting questions in the chat or later at the end. Okay, when I come back on for the Q&A, I want you to challenge me. Don't be nice. Challenge me about the information that I'm going to give you. Because again, the stuff I'm sharing with you is not what your parents taught you. It's not what your grandparents taught you. It's not what your friends, colleagues, and coworkers taught you about money. So I want you to keep an open mind as we go through this. We're going to talk about how your money flows, the method to get all of your money back. We're going to talk about the mysteries of money, the machine. In just a couple minutes, I am going to show you what that machine is that we're going to use to build, keep, and create wealth. And Sarah's already hinted on what that is. We're going to talk about the mission, the marathon. This is not just a get-rich-quick deal. All right. This is one step that you're going to want to add in your financial life. And by doing that, it is drastically going to improve your financial life. So it's not a sprint. It's not a get-rich-quick deal, right? This is one step we're adding. Now, keep in mind, I'm telling you one step we're adding. I don't want you to change anything. I don't want you to change your cash flow. I don't want you to work any harder, take any additional risk, or lose control of your money. So whatever you're doing right now with money and it's working, continue to do that. We're just adding one step. We'll talk about the millionaire and the movement. Okay, I've got 3 calculators on the screen. Now, I know the last thing most of you want to do right now is math, but I'm going to keep it really easy. Now, the calculator on the right is going to be your savings or checking account at your local bank, okay? So I'm going to assume you guys all have a savings and or a checking account, and I'm just going to say you have $25,000 in that account. It doesn't matter if you do or you don't, but let's just say you do. You may have more, you may have less, and you are in the market to go buy a car. You want to purchase a car, and that car, well, actually, just before you purchase a car, in that bank account where you have $25,000, that bank is paying you 4% interest on your money because it's in the bank. You've got it in this checking or savings account, and they're paying you 4% interest. Now, I know they're not paying you 4% interest on your money, but I'm going to make believe that you found a really, really good bank, and that bank is paying you 4% interest on your money. And you are in the market to purchase a car, and that car just happens to cost $25,000. And I'm going to be your banker at that local bank. And here's what you do. You come in that bank and you say, Brent, I'm Banker Brent. You say, Banker Brent, I want to take out the $25,000 that I'm earning 4% on, and I want to go pay cash for the car. And I say, no, no, no. You do not want to take the $25,000 out of the bank that's paying you 4% and pay cash for the car. Instead, what I'm going to do is I'm going to make you a loan for $25,000, and I'm going to charge you a 6% interest rate. And I'm going to say that you're going to finance that car for 5 years or 60 months. Now, it doesn't matter if it's 4 years or 48 months, 6 years or 72 months. In this example, we'll use 5 years or 60 months. Now, I want you to keep that money, the $25,000 that you already have in the account, and our bank is still going to pay you 4%, but I'm going to make you a loan to buy the car, $25,000 at 6%. And over the 5 years, 60 months, equal time period, our bank will pay you more money on the 4% that you're earning than you will pay us on the 6% that you're borrowing. Now, is that a true statement? In other words, is it possible for you to make more money earning 4 at the same time you're paying 6? Well, back when I heard this in 2006, I was shaking my head. Well, no, man. If I earn 4 and pay 6, I'm losing 2, right? That's how our simple minds work. So that's what I thought. Well, look, the banker told you the truth. And let me walk through that. If you borrow $25,000 from a bank at 6% and make payments for 5 years or 60 months, your payment is $483.32 a month times 60. So that means what you've done is you've paid $29,000 for that car. You've paid $25,000 in principal and almost $4,000 in interest. Are you with me so far? Now, that same money that I'm telling you to leave in the bank at $25,000 earning 4% over the same equal time period of 5 years or 60 months, you will actually have $30,525. Now, is that number right there, the 3525, is that a larger number than 28,999? Or do you guys do math differently than I do in Florida? That's right. It's a bigger number. Well, how can that be? How can you have more money earning 4 at the same time you're paying 6 over the same equal time period? Well, here's what's happening. The dollars the dollars that you have in the bank are going up every month. Those are going up. It's on an increased balance. The car payment, the car balance is going down. You're paying down that balance every month. So one goes down and the other one goes up. But see, our minds are not programmed to think that way. We think if we earn 4 and we pay 6, we're losing 2. So we have to start learning how money works. Now, the same thing will work is if you earn 10% over here in your bank. So on the calculator on the right, if I change that to 10 and I said you pay 20, so earn 10 and pay 20 over the same equal time period, you will actually have more money earning 10 at the same time you're paying 20. But for this concept, for this method, for the method of my madness today, all I wanted to do is prove to you that you can make money all day long earning 4 at the same time you're paying 6. Now, why is that important? The reason that is important is because I'm going to show you. You ready? Let's talk about the machine that we're going to use to build, keep, and create wealth. Are you ready for the machine? A lot of you are saying yes. But when I show this to you, a lot of you are going to tune out and you're going to leave this Zoom meeting because you're just going to leave it because when I show you what it is, you're going to be like, no way. I've heard everything there is to know about this, and there's no way that can work. Well, the machine that we're going to use to build, keep, and create wealth is a whole life insurance policy that pays dividends in a mutual company. Now, I know what you're thinking. A whole life insurance policy, Brent, why on earth would I ever want to use a whole life insurance policy to build, keep, and create wealth? You're thinking, I know everything there is to know about whole life insurance. No, 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 you do not. Because if you did know, you would be implementing this concept in your life. The reason that we're doing this is because this is what the rich do. This is what the wealthy do. As a matter of fact, the number one purchasers of whole life insurance in the world are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since the year 2014, conventional banks have quadrupled the amount of life insurance they've purchased. Now, why are they buying so much life insurance? Is it because they're stupid or they know something the rest of us don't know? That's right. They know something the rest of us don't know. So all we're going to do is mimic and imitate what the wealthy have been doing for over 200 years. Because look, I did not invent this concept. The guy that wrote this book, R. Nelson Nash, didn't invent the concept. It's been around for over 200 years. As I stated earlier, go research the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays. See how they build, keep, and create wealth. So all we're going to do is implement the strategy that they've been implementing for over 200 years. We're not going to change. All right. The thing is not reinvent the wheel or change what we're doing. We're adding one simple step. Now let's go back to the 4 and 6. Why is the 4 and 6 important? Because inside of the policy, your growth rate is actually greater than 4% with dividends. It's greater than 4%. Now, is that growth in your policy? Is that taxable growth or tax-free growth? That's right. It's tax-free growth. Inside of your policy, that money is growing tax-free, okay, at 4% plus, and it's actually greater than 4% with dividends. Even though the insurance company is never guaranteed to pay a dividend, they don't have to pay a dividend. Every company we use has been paying dividends for over 123 consecutive years without fail. Why is the 6% important? Because 6% is the highest interest rate the insurance company will charge you to take a policy loan. So can you make money all day long earning 4 and paying 6? The answer is yes. Okay, why use whole life? Because this is what the rich do. This is what the banks do. Banks are the number one purchasers. And if you don't believe that, Go ahead and ask in the chat box a couple people that are on this call that I've been working with for years, maybe some of them just recently, some of them for years, and ask them if this works, if this concept works. Now, keep in mind, this is not any whole life policy. No, no, no. This is not the whole life policy that you can go buy from your brother-in-law that sells life insurance, right? We all have a brother-in-law that sells life insurance. It's not a term policy. It's not an index universal. It's not a variable policy. It's not a UL policy. This is a specifically designed whole life policy in a mutual company that has high immediate cash value. One more time, high immediate cash value. So what that means is when you put money into the policy, you have cash value available immediately. My definition of immediately is within 30 days. So when I say immediately, you think 30 days, okay? That's right. Now, BOLI, go Google BOLI, bank-owned life insurance, and you will see the hundreds of pages that come up on how much whole life insurance conventional banks actually own. We're just going to mimic and imitate what they do. So can we make money earning 4 at the same time we're paying 6? Absolutely we can, right? I just proved that to you. Okay, the definition of money. What is the definition? You guys tell me a lot of different things. Well, all money is a means of exchange, is it not? That's all we do is exchange money. You exchange money for food, food for money, car for money, money for car, house for money, money for house. Anything that you buy, you exchange that for money. So the definition of money is a means of exchange. Who in here believes in compound interest? Most of you believe in compound interest, but keep in mind, the only way compounding works is your money or your product has to sit still. You want that money to be continuously in motion. You want to have continuous motion of that money. And an example of that might be an IRA, a 401k. Now, I'm going to kind of skip over some of this because my time is limited. But remember, anything I skip over, you'll be able to see my whole full 90+ minute recorded presentation on this. But I want you to think of a couple things in your IRA or 401k. Now, I'm not talking about self-directed. That's a different animal. But your traditional ROA, your traditional or your Roth IRA, are there any guarantees at all with that money? No, well, there is one guarantee. It's guaranteed to never go below 0. But how exciting would that be if that actually happened? So I just want you to keep that in mind. And who controls it? Do you control it or does somebody else control it? Yes, somebody else controls it. So this is all about you being in control of your own money. All right. So I'm going to skip a couple of these parts here. But a couple things I want you to think about. Is a dollar worth more today or in the future? Is a dollar worth more today or in the future? It's always worth more today. And if you forget that, think about how many candy bars you could buy 25 years ago for $1 and how many you could buy today for $1. Are taxes going to go up or go down? That's right. The history has been that taxes go up. Look, even if taxes don't go up, aren't we taxed on more stuff all the time? Yes. And if you have a choice to pay tax on the small amount, the seed, or the large amount, the harvest, which one do you want to pay tax on? Yeah, the small amount, the seed. Well, think about this. Everything that you do in a 401k or an IRA or a qualified plan, it violates every one of those answers. Because when you put your money in a qualified plan, what's happening is you give up your good dollars today to get paid back with non-guaranteed weaker dollars in the future. Okay, the thing you're doing is compounding the tax because the tax is always going to be there on your money. And when you do pay the tax, you're paying it on the big amount and not the small amount. See, the idea is to pay tax on our money one time only at the lowest rate possible. Get that money into a tax-free growth environment and get the government completely out of our hair. Is that not it? And for you to be in control. All right, so I'm going to skip over again as I say a couple things because just of the time. So now let me show you. Oh, by the way, so the thing I want you to do is I want you to go out there, the bank that you work with or any bank that you work with, I want you to go out there and I want you to get your annual report from your bank. And the way you do that is go to this website. It's bauerfinancial.com, BAUER. And what you will see is that banks are making between 400 and 1,300% on the money that you leave there each and every year. Don't take my word for it. Go look at this report. Look at all the money that a bank is making on the money that you leave there. And then you think the bank is doing you a great job when they're paying you 2, 3, 4, 5%. You're like, man, I'm getting good return on my CD or the investment that I have that the bank is controlling, right? Or even for that matter, a qualified plan, a 401k, an IRA. But I want you to think about how much banks make on an annual basis. And I'm going to challenge you. If you find a bank that makes less than 400% annually on the money that you leave there, you owe it to me to tell me, and I will change my presentation. I have been teaching this concept since March of 2012. So I'm almost 12 years now, and I've used this same screen, the same resource the whole entire time. Nobody has ever showed me a bank that makes less than 400% annually on the money you leave there. Maybe this group will be the first. Okay, so now we're going to go in and I'm going to show you how to get all the money back on all the cars you're going to buy, drive, and own for the rest of your life. So not only do you get the car, but you get the money back. How cool would that be? Well, remember what the machine is that we're going to use. We're going to use a whole life policy in a mutual company that pays dividends, right? That's the machine. That's the extra step. We're putting money into the policy first, and then from the policy, we're going to use the money to go out and buy the stuff that we're going to buy in life anyway, such as a car. So when you put money into the policy, it's a premium. So yes, I know it's a payment. It's a payment. We pay the insurance company. You decide the amount to pay. That's right. You make the decision of how much you want to put in your policy. We will never tell you how much to put in. So we're going to think of a premium as a deposit. I know it's a payment, but if it's going into an account that you control and have immediate access to cash, remember immediately within 30 days, is it treated more like a payment or deposit? That's right, a deposit. And what word do you like better? Deposit. Age doesn't matter and death benefit doesn't matter. That's the bonus of the policy is the death benefit. We are not here talking today about death benefit. As a matter of fact, you see this far right column, I have death benefit grayed out, right? We're talking about the cash in the policy, all right? So on the left, you have time, policy year 1 through 8 and 9 to 13. Age doesn't matter, death benefit doesn't matter. In this example, we're going to put in $10,000 a year into the policy for 7 years. If the number is too big, take a zero off. If it's too small, times it by 2, 5, 10, or double it, whatever you want. At the end of the 3rd year, beginning of the 4th year, we're going to use the money in the policy to buy a $25,000 car. In real life, we would never wait that long to use the money. I want you to use the cash value immediately. Immediately is within the first 30 days. But in this example, we're going to wait to the end of the 3rd year, beginning of the 4th year. So we're going to put money into the policy. We're going to borrow $25,000. We're going to put our policy up for collateral, take a loan from the general fund of the insurance company of $25,000. That money we're going to borrow, we're going to pay ourselves back with interest. Because look, if you borrow money from a bank to buy the car, you would pay them back with interest. You wouldn't ask any questions or skip a beat, would you? So do you think it's a good idea that if you borrow from yourself, you should pay yourself back? Absolutely. But we never do it, do we? No, you never pay yourself back, but you always pay a bank back. So what we're going to do is pay ourselves back with interest, and to keep the math simple, $500 a month or $6,000 a year for $30,000. So look and see what we did here in 8 years. In 8 years, we put in 10 times 7 is 70, 6 times 5 is 30, for a total of 100,000. 100,000. But we took out 25, didn't we? So if we put in 100 and took out 25, put in 100 and took out 25, how much more did we put in than we took out? The answer is 75,000. Well, look at the cash available in the policy. 73,226. So if you take 73,226, divide it into $75,000, which is our net injection, that means you just got back over 96 cents or 96% of every dollar on that first car that you bought. Now, how would you, ladies and gentlemen, boys and girls, like to have 96 cents back of every dollar for every car that you've ever bought, driven, and owned, or are going to continue to buy, drive, and own? 96 cents of every dollar. You don't have it. How much do you have? Zero. And all I did was what? All I did was what? I added one step into my financial life. I bought this stupid ass life insurance policy and I'm using it to buy the car. You're thinking, Brent, that wasn't nice. Why did you use the word ass? Because a lot of you on this Zoom meeting are not paying attention. You're washing the dishes, you're burping the baby, you're watching TV and trying to watch this, or you're walking the dog. But ever since I used the word ass, now I got your full attention. There's something about the word ass that just brings you right back to the screen. So thanks for your attention again. All right, now watch this. Now I want you to watch year 9 to 13. So guess what we do in year 9 to 13? Now I go buy another $25,000 car. Where does that $25,000 come from? It comes from the 73,226. In this example, I'm no longer putting premium into the policy. I would never tell you not to put in premium in the policy, but I want to isolate the car loan. So now what did we do? I want you to look at year 9 to 13. We now are going to take out $25,000 from the policy to buy the car. Again, we're putting our policy up for collateral, taking a loan from the general fund of the insurance company. We're not putting premium, but we're going to pay ourselves back just like we did for the first car. $500 a month or $6,000 a year for 5 years, a total of $30,000. So now what did we just do? 9 to 13. Well, we took out 25, put back 30. Took out 25, put back 30. So how much more did we put back than we took out? Well, if you took out 25, put back 30, our net injection is $5,000. That's right. How much money, how much cash do we now have sitting in the policy cash value on policy year 13? That's right, 95,000 and some change. So look what just happened here. From year 8 to year 13, that policy grew from 73 to 95. That is a $22,000 growth with a $5,000 net injection. How do you like buying cars my way? Is there anything stupid, ridiculous, or idiotic that I'm doing? No, man. All I've done is added one step in my financial life. I'm using the policy to buy the car. All I've done is I've added this life insurance policy because you're going to buy the cars anyway. Just, okay, I want you to think of all the cars you've bought in your life for yourself, your spouse, your kids, your grandkids, your nieces, nephews. Think about all the cars that are on your life. And the car that you're driving right now, is it the last car you're ever going to drive? No, not unless you plan on dying, passing, or graduating in the next few months. You're going to continue to buy cars just like you have been. So this is just one example of using this concept for a car. Well, if I could use this for a car, what else could I use it for? Anything. It's infinite. It's unlimited. Hence the word infinite banking concept. Now watch this. If you've been sleeping, you got to wake up for this. Look and see what we did for 13 years. How fast does 13 years go in your life? Well, I can tell you I'm 56. It feels just like yesterday I was 43, right? 13 years goes by quick. Well, let's see what we did in 13 years. We put in $10,000 a year, paid it for 7 years. So 10 times 7 is 70. Then we paid back, 6 times 5 is 30 for the first car, 100,000 total. And then in year 9 to 13, we put in 30. So 100 plus 30, 130,000 is our true net injection, right? But we took out to buy 2 cars, 25 and 25, a total of 50. So if I put in 130, took out 50, put in 130 and took out 50, my net injection is what? Well, 130 minus 50 is 80. 80,000 is our true net injection. how much cash do we have in year 13? It's okay, you can say it, 95 and some change. So wait a minute, Brent. Are you saying I put in 130, took out 50 to buy the car, so my injection here is 80, but now in year 13, I've got 95 in cash? Absolutely, that's what you have. And not only do you have 95,000 in cash, guess what else you have? You have two cars. You have a 5-year-old car and a 10-year-old car that you've owned, driven, and used the whole entire time. You can continue to drive and own, use those cars. You can sell them, give them away, donate them, whatever you want. So if this is true, which it is, how much did it cost you to buy, drive, and own the cars? Well, my simple mind says nothing. You made money, right? That's the way my simple chiropractic mind thinks, is that you made money. Well, I can't sit here and tell you it cost you nothing because you had to start the concept, the process. Because look up here in year 1. In the first year, when you put in 10, the full 10 wasn't available. Only 5,800 was available. But that's okay. Are you in this for the short term or the long term? I know you tell me long term, but we tend to get hung up in short term thinking. I will challenge you to go read a book by Rick Warren called A Purpose Driven Life. Rick Warren says life is like a marathon. It doesn't matter where you start, it only matters where you finish. This is the game of life. So if this works for a $25,000 car, would it work for a $250,000 house? Absolutely. Just add a zero to all the numbers. Would it work for a $2,500 laptop computer or a TV? Absolutely. Just take off a zero. It doesn't matter. Any product or service, you're recycling and recapturing the money. Have you ever heard of Robert Kiyosaki? Robert Kiyosaki is famous for a book called Rich Dad, Poor Dad. He also wrote a book called Second Chance. In that book, Second Chance, this is exactly what Robert Kiyosaki talks about. But when you read the book, you skipped right over it because it was too complicated to understand. Have you ever heard of a guy named Tony Robbins? Tony Robbins wrote a book called Money Master the Game. This is exactly the concept Tony Robbins was talking about, but when you read that book, it was too complicated to understand. You just passed right over it, right? This is what the wealth are doing to building, keeping, and creating wealth. Like I said, the concept's been around over 200 years. There are a few different rules. There's 3 rules. Number 1, policy premium deposit. Pay yourself first. Pay yourself first. I know we've heard that term before, but you don't do it. See, I don't even know you, and I know what you do with your money. Every time money comes in, the thing you do is you put it in the bank and you pay everybody else first. You pay the house payment, the car payment, the student loan, food, travel, entertainment, Bobby's soccer practice, Susie's piano lessons, and you hope there's money left over for you. You have to start paying yourself first. Rule number 2, pay yourself with interest. That's right. Treat your money the same way you treat a bank's money, because if you don't, you're saying your money's not as valuable. And rule number 3, recycle and recapture the money. All right, 3 rules. Pay yourself first, pay yourself with interest, recycle, recapture your money. If this works for a car, what else? Anything else that you want. Here's 2 other books I'm giving you to add to your wealth building library. Total of 4. There's Second Chance, Robert Kiyosaki, and Tony Robbins, Money Master the Game. All right, I'm almost out of time. I got 4 minutes left. This, okay, and again, everything that I'm not showing you, you're going to be able to watch. I'm going to show you, but this idea right here is the Money Multiplier map. When you watch this on the recorded presentation, the Money Multiplier map, you will understand how I paid off $984,711 in 39 months. I don't use my exact example. It's a little bit too more in detail. But in this example, this individual, this client, paid off about $470,000 in 5 years with a $160,000 outside injection. That's right. He paid off almost $470,000 in debt and injected $160,000 of outside money and kept his cash flow the same. All right, let me skip here to where I'm going to end for now, or almost. I got 4 minutes left. Now, you're probably thinking, why haven't I heard about this before? Because if you think about it, how many wealthy, rich people are you around that are teaching you and talking to you about how the wealthy build, keep, and create wealth. There's not a lot. So that's why I'm giving you the information. And don't take my word for it. Look, after I'm done today, there's lots of content that you can go out and watch on our website. There's podcasts, Zoom calls, case studies, plan design, success stories, testimonials. I mean, there's probably a bunch of people in this chat box that we already work with that you can just type in the chat, or when you're asking Hannah the questions in the Q&A, about how this has worked in their life. So anyway, this guy here, Jim Harbaugh, the college football from the University of Michigan, this article came out in 2016. Cash value life insurance makes Jim Harbaugh one of college football's top paid coach. What they do is they're able to pay his salary. The university pays his salary through cash value life insurance. So not only do they pay the coach his salary, but they also recycle, recapture, and get that money back because that money stays in the family. Much like when I own chiropractic clinics, how do you recycle, recapture the money, and the money stays in your family for all your overhead? Or when you buy real estate, how does that money stay in the family? Because you're adding this one step, because there's no money being leaked out to other people. Walt Disney, look at Walt Disney. Walt Disney wanted to start Disneyland, but after failing to get a loan by traditional means of financing, here's what that means. Walt Disney walked into a bank and the banker said, no, Disneyland, that doesn't sound like a very good idea. We're not going to loan you money. So Walt had to provide his own financing, and a large part of that came from him collaterally borrowing money from his cash value life insurance. Who knows if we would even have a Disneyland if it wasn't for cash value life insurance? Ray Kroc, McDonald's, the same way. He had to use money in order to pay his key salary employees and to start the advertising campaign for Ronald McDonald. Pampered Chef, Doris Christopher, she started in 1980 this company using $3,000 she borrowed from her life insurance policy to start this crazy little business called Pampered Chef, which she later sold to Warren Buffett for $1.5 billion, billion with a B. There you go. This article is almost 10 years old now. Look what it says. Joe Biden has no stocks, bonds, or savings account, but at this time, he owns a total of 6 life insurance policies with a company that we have policies with, a mutual company. Who knows how many life insurance policies Joe Biden owns now, 10 years later? Or maybe he doesn't own any of them. Maybe Hunter has them all. Sorry, I always lose a few people from that joke, but it's a good joke, right? All right. Stanford University, same thing. J.C. Penney, all right. Foster Farms, the list goes on and on. Now that you know this information, everybody should do it, because if you don't, not only are you stealing from yourself, but your children, grandchildren, and future generations, because money is leaving the family. We want to keep money in the family. Here's what Warren Buffett said, and I think about this quote every day of my life. If poor people would just start doing what rich people do, they wouldn't be poor anymore. How much sense does that make? All we're going to do is mimic and imitate what the wealthy are going to do. All right. I got to skip through this because I'm out of time. But listen. Oh, hang on. Why are we doing this? There's a lot of reasons that we're doing this, but here's one.
I want to be a billionaire, so freaking bad. Buy all of the things I never.
Okay. If this is something that you want to do or want to learn how this may work for you in your life, here's what I want you to do. Oh, reminder, if you send me an email, brent@themoneymultiplier.com, brent@themoneymultiplier.com, I will send you this ebook, and I'll also send you the full presentation as well. So brent@themoneymultiplier.com, or if you don't want to send me an email, go to our website, themoneymultiplier.com. Take a picture of this screen, take it down. This is how you can contact us. Right there's my texting number. There's my email address. You have my daughter Hannah also on the chat box. Actually, her email is Hannah, HANNAH, @themoneymultiplier.com. If you want to schedule a call with a money mentor to see how this will work in your life, there's the schedule link. You can go schedule right there. And if you want to watch the full recorded presentation, that's how you do it. View the presentation and just click on Watch Brent Now. I don't know anything about QR codes, but my team put it up here. So you guys that know about QR codes probably know what to do. I don't know what to tell you to do with that. But here's the last thing I'm going to leave you with. All right. Listen, if you think the stuff that I told you is too good to be true, remember, I thought it was too good to be true in 06. Do not take my word for it. Go out and do your own research. And even if you do decide to work with us or anybody, you can't just start working with us immediately. It takes 6 to 8 weeks for you to be able to get approved for this policy. So you're going to have a ton of time to do all the research, but don't put this aside. Either make a decision, either put this aside and say, no, that's not for me. I'm going to move on and never look back. Or go out and do more research on this concept that I'm sharing with you, because it is a life-changing event. And it's either going to be one or two things. You're either going to make a decision to go forward and look at it more, or make a decision not to. Either way, you're going to make a decision. It's totally up to you. And I will leave you with this. There's a lot of people that should be on this call that are not on this call. Here's what I'm asking you to do. Please send them this full recorded presentation. Have them watch this themselves. After I send you the ebook that I'm going to send you, if you reach out or you go on, go show them how to get our ebook, and just kind of follow us and watch what we're doing. We're constantly putting more and more content. All right. I apologize. It looks like I'm 3 minutes over, Sarah, if I did my math right. So Sarah, Cynthia, I'll throw it back to you. I'm here to serve you and your members and your listeners, and I'm grateful and gracious, and I'm humbled to be on here today, and thank you for allowing me to share.
I think that was awesome. Thank you, Brent. And you had so much action in the chat where it was social proof of people who work with you, who are giving you and your company and your daughter accolades. So, congrats. It's always, people can go out and do their research, but also that was pretty telling when people's own clients are saying, hey, real deal, you guys should do it.
Awesome. Thank you for that. Yeah. And again, it's all about helping you, and we're going to serve you. That is our mission. I'm a very big believer on what the late Zig Ziglar said. And here's what the late Zig Ziglar says. He says, if you help enough other people get what they want, you end up getting what you want. So it's my mission to serve as many of God's children as possible. So that's why we're here doing what we do. And it's a blast. I mean, because the thing we do is we're helping people to build, keep, and create financial wealth, much like what you do with sharing all of the great speakers that you have coming on your stage and giving them the nuggets that other people just aren't giving. So kudos go to you too, Sarah, for you and your team for sharing what you share.
Well, I feel so blessed that I meet people like you and the other speakers in life. And when someone changes my life, I feel like I have to pass it on. And I have a slide and it says fast lane, slow lane. And I want everyone to go in the lane that's much faster than the lane I went in.
I always say, Sarah, it's easier to go fast than it is to go slow, right? It's easier. So like if you ask my wife, she's like, sometimes the thing she tells me sometimes is she says there's two speeds you have. You either have off or totally turbocharge 1,000 miles per hour. And I say, honey, well, if I'm off, I'm off. I'm down. I'm enjoying the downtime. But if I'm on, why not go fast? It's so much easier to go quicker than slower.
I 100% agree. 100% agree. Well, thank you, Brent. And we will see you in about 45 minutes in the Q&A.
All right. I look forward to it. Thank you, everybody. Be back soon.
All right. So now I'm going to grab the screen, share my screen. Let's see. I'll bring it up and I'll get into my presentation. All right. So I'm going to start with a couple questions. One, I think I already know the answer because I luckily got to speak after Brent, so everyone's already jazzed up. But are you guys loving this education? Have you learned something? If so, please put in the, I see a bunch of yeses already, but please put in the chat education, because that's really the goal of this event, everyone's asking you, contact if you want more information. So it is just the tip of the iceberg. This is like, oh, that's interesting. I'm going to go learn more. It's all about education. And I'm going to talk to you about my journey, not because it's that entertaining, but because it's all about education and then action. And so that you can see when you put the two together, how life-changing it can be. All right. So, everyone's here for a different reason, right? So the event name is the Confident Investor. So we're not here to lose money. We're not here to do anything that negates the money we have. We're all here to expand our wealth in some way. However, everyone is doing it in a different way, right? We all have a little bit different goals. And so in a little bit different values when it comes to investing. And so I'd like to know, I'm going to put it up in a poll. I would like to know why you guys are here, because it helps me serve you better. Because what I do, my goals are not the same as Stacy, our investor relations team member. She has different goals from Cynthia. She's our marketing, Elisa, our marketing. Like, we all have different goals. So we invest for different reasons. So I'd love to know you guys. You guys are a brand new batch of people that I'm just getting to know for the first time. And so in order to kind of make sure I focus on the right things for you guys, I want to know, are you here? And I'm going to put up a poll. Are you here because what would really benefit your life today or in the future is monthly cash flow? That is really your primary reason for investing and being here. If your primary reason is to reduce your taxes, because you can, do a lot with your investing portfolio to reduce your taxes, I'd like to know that. And if you're primarily here to increase your net worth, for wealth building, I would like to know that. So I'm going to bring up the poll now. Just going to move this and put it up, but I wanted to explain it. So here we go. The poll is up. So you guys can go ahead. I'm just going to take about 2 minutes. So just do it quick. You guys should all see. Okay. So awesome. If you could, oh, great. Beautiful, beautiful, beautiful. So I want to know ranked, like everyone wants all of these, right? But I want to know what's most important to you and least important to you. Most and least. So some people might say they're all most important. They're all my priority, but really there is, more of a focus that you usually have in one of these areas. Okay, I'm watching the results. This is really helpful. We have about half of you have answered so far. Let's see, we'll give it a little bit more time. So do this in the poll, please. So I see a bunch of you ranking in the chat, and that is super cool. Putting it in the chat to hosts and panelists. However, if you would put it in the poll that's on your screen, if you can see that poll, that would be really cool, because then we get a sense of really, really what portion of people rank this. So, okay. By far, so far, and it's still about half of you. So let's see if we can get another 10%. But looking at the results, biggest reason people are investing is for monthly cash flow. Second is for net worth or wealth building in the long run. And of medium importance, lower importance is taxes. Okay, cool. So that's really great for me to know. I'm going to go ahead and, oh, I see someone saying if you're on iPad, iPhone, Apple products, there's like 3 tabs on the side you need to click to see it. But anyway, this gives me a pretty good idea. So it helps me know where to spend my time. So I won't spend a ton of time on taxes. I'll just hit on them quickly. And I'll go more into cash flow, which is great. Tanisha talked about it yesterday. Brent talked about some things today that are going to wrap into talking about cash flow and also wealth building. All right. Thank you for the participation. I'll share the results. You should be able to see it. There's the order. Okay. So in my 45 minutes that I'm going to be up here, I'm going to try to talk as fast as Brent. so that I can give you as much value as he gave you. So I'm going to talk about how to plan your investment portfolio like the $100 million pros. So there's, if you guys are familiar with family office, so family office is folks that, and you know, the number is kind of irrelevant, but for instance, if I have $100 million, that is so much money that I'm not individually trying to take responsibility for my own money. I would have a family office where I have a full-time CPA, a full-time financial planner, a full-time asset protection person, full-time investment planner and due diligence on investments. Like I have a team. I don't, this is not me, but I'm saying if I had $100 million, I would have a team, and my team is my family office. So I went to dinner. I go to events all the time with family offices. I went to a dinner last night, and it was about 30 family offices. We sat at a bunch of round tables and just talked about what's important to them right now, given what's going on in the world and in the US and the economy, and certain levers that are being pulled, manipulated, changed drastically. And so I love getting the download from them, because that's who I want to eventually be, right? And so we've talked about who to listen to. And so I'm not listening to, you know, someone who's my neighbor who their investment portfolio is worth $500,000. I'm going to listen to someone who their investment portfolio is worth $100 million, right? You want to look at where you want to go. And so Brent talked about that too. Most people that I talk to who have a family office, they have the most insane and complex, robust structure around whole life for extended family members, businesses, etc., just like Brent said. And so I always want to hear that. So I'm going to talk about how to plan your portfolio, the investment side of it, like the pros too. I'm going to review 15 ways to make money investing, and there are 5,000 other ways. These are ways that I have studied or invested in, and would consider myself more of a guru. And we're going to talk about percents, like what percent of your net worth should be in real estate, what percent should be in crypto. Spoiler alert, family offices, high net worth folks have a much larger percent in real estate than you would expect. What else am I going to talk about? I'm going to talk about, touch on taxes. So how to reduce your 2024 income taxes, even your W-2 income taxes. So some of you know, okay, well, there's real estate that only affects my passive income. I'll just give a strategy around that. And really how to diversify your expertise. So how to pivot for long-term longevity for your portfolio, not just for, you know, what's happening this year. So we've all talked about this on this event. What do the wealthy do? They earn more, they keep more, and they grow more. So I'm going to focus on the grow more with investments. So for those of you who were here yesterday, I give a little brief info about myself, but I'll talk a little bit more about myself right now. So Sugo Capital, Stu is Sullivan and Go is Gogoli, but we thought Sullivan Gogoli would be a mouthful. So Sugo Capital is the company, and the founders are Sarah Sullivan and Theo Gogoli. And you'll see Theo later, not on this event, but you know, further down the line of getting to know us. And what we do is we connect investors to passive income opportunities. So although we put on events like this month after month, what we really do is connect investors to passive income opportunities. So you're going to learn a lot and work with a lot of people that you meet through the ecosystem. And then when you choose to work with us, just know that everything will be completely hands-off. And I'll explain those structures in a bit. We started in 2019. And what have we done since then? We have acquired 36 apartment buildings with our investor partners, folks like you. And so that's about 850 million assets that have been acquired. $850 million in assets acquired. So these are not 10-unit apartment buildings. These are 100 to 400-unit apartment buildings across Texas and the Sun Belt. And I'll talk a bit about how that works. I'm an advisory board member of 2 investment firms. And then most of all, what I'm most proud of is that we have educated over 20,000 investors through events like these or through webinars and the content that we put out. So, you know, through our live events. And so I think that's really great. And I get feedback from everyone. So you guys are active in the chat. And then you guys are really active in email feedback as well. We do surveys all the time. And so we take what's valuable to you and what's not valuable to you, and we craft the next educational series. So just know that. Always give us feedback on what you like and don't like so that we can serve you guys better. We love this community and we love community building. All right, why am I qualified to speak to you? What's so great about me that I have something to share? All right, so I'll talk a bit about my results. So this is a before and after picture of the beginning of my journey. So 10 years ago, Brent talked about Rich Dad, Poor Dad. I read that book and I was like, this changed my life. I'm going to go from corporate to being, this real estate guru, and it's going to be amazing. So I bought a duplex, and this is before and after. The before is on the left, the after is on the right. Normally you want it the other way around where, I have this fixer upper and look, it's so great. And I sold it for a profit. Well, we didn't learn enough about due diligence on team, which I always teach team is the most important thing to do due diligence on when you're a passive investor. So it's really different than when you're an active investor, you're doing all the work, right? But when you're a passive investor, another team has your money and they're doing all the work. So we did not do great due diligence on the property management company. They put in some tenants who were evicted from their last place. They didn't check that. I didn't think I'd have to ask my property management company to do that. Turns out you do have to make sure they do that. So anyway, they put some tenants in who had giant dogs. Pets were not allowed. The dogs trashed the place. The tenants didn't pay. I mean, it was just a catastrophe. It was in Indiana. We live in San Francisco. It was really not worth the headache. And so we ended up selling it at a loss. But I did not walk away from real estate, and I did not walk away from investing. And I say that this is really important because I hear so many times, and I heard from my family at this point in time, oh yeah, my friend Laura, same thing happened. She bought that duplex and she lost some money on it. So I'd stay away from real estate. Oh yeah, same thing. My brother, he bought a duplex over, down the way, and he had some awful tenants. I would stay away from real estate. I heard that so much. And that was from people who did one or two things incorrectly and stopped. But is that who you want to listen to? I was listening to the people who I looked at and I said, they have $1 billion under management and they are going gangbusters on real estate. They made some failures on the way for sure, but they didn't stop and decide investing was not for them. They kept figuring out, okay, what was the lesson that I learned from that failure? How can I pivot my strategy? How can I become an expert in something else because this thing wasn't for me, and keep going? And so that's what I did. I studied over 15 different types of real estate investing for years and years and years, from numerous courses and coaching programs. And then I started to invest as a passive investor in apartment complexes and hotels. So this means I put my money in and I was completely hands off. Someone else did the work and I was, working my corporate job in Silicon Valley. Okay, and then I was receiving 18 to 25% annualized returns for doing nothing. I was like, well, this is way better than managing, duplexes across the United States remotely and losing money and the headache and yada, yada. So I said, hey, this is pretty cool. I think this is really great. And I continued my learning journey. And some of you who were here yesterday, part of my journey was learning, but then I had to take action. So you can see on this chart, I was learning, starting 10 years ago, but it wasn't until 5 years ago when I had kind of a come to Jesus moment, a really harsh look at myself. And I said, you know what, it's time to take action. And you'll hear about my story later, but I won't go into it right now. But that was the alarm clock when I went, okay, I need to take action in a different way. And I did. And that's when my income really catapulted. That's when I was able to replace my earned income with passive income from my investments. That's how I was able to 10x my net worth in 5 years, was through everything I'm about to show you. And, it's a ton. I only have 45 minutes to talk. So what we're going to do is next week, so starting on Monday, you're going to get 3 emails from me. And in those emails, there's a lot more information about my story and investing and how to invest. So I pulled some slides from that information. I'm going to talk about it today, but know that on Monday, you're going to get 3 emails. So pay attention to your emails next week, and it's going to have all like, okay, this topic, and then we deep dive into it so that you can kind of pick and choose what areas of interest and dive into it. So one thing that's really, really important, and a lot of investors don't take time to do, and Stacy, she's on here, she's our investor relations team. She says this all the time as well. We get on the call with investors and we say, what are your goals? What are your priorities? And they go, oh, well, I don't know. And it's like, well, we can't suggest an investment for you if we don't know what your priorities or goals are, because all investments work differently, right? So if you put in money with a VC and they hold it for 10 years and you get no cash flow, and maybe you get a 10x in 10 years, or maybe you get nothing, like, we're not going to recommend that investment if your goal is, I'm quitting my job next month, I need cash flow. So your first area of responsibility is to take charge yourself and figure out, what is your goal? Why are you here and why are you investing? And so this is a picture of me when I realized I had met my goal. So for me, time freedom, location freedom are really, really important. I love traveling, I love seeing new places, and I love bringing my family. So with a W-2 job, that was really hard on 2 weeks a year vacation. And so eventually, when I had my passive income replace my active income and I started my company, I could work from anywhere. So this was a vacation we were on. Everyone was having a fabulous time. We were in Arcachon, which is in France, and it's a bay that has over 20 different oyster farms. I love oysters. So we're just riding our bikes around, going to different oyster restaurants and having nice wine and hanging out in France and on the beach. And everyone said, we want to stay longer on this trip. And I said, we totally can. I don't have to go back to a job. We don't have to go back home. We have the money to stay longer. It was really the moment when I went, oh, I planned. I made a plan, I executed on the plan, I was diligent, and I reached my goals. Now, your goals would be totally different than mine, but I really want to encourage you to write down your goals and work towards them. And again, that series that comes out next week, we're going to really dive in on how to make goals and how to take incremental steps in a really simple way towards them. All right, so investing like the wealthy. So what have I learned from, having dinners, lunches, brunches, etc. with these family offices? So they invest really different, and it's chicken and the egg, cause and effect. But according to your net worth, there's a different allocation of your wealth towards different asset classes. So the bar on the left, this represents people who have a net worth of 0 to 500,000 roughly. So half a million, 0 to half a million. The green represents kind of traditional investments, like your home. You think your home is an investment, an asset, which yesterday, the idea was introduced, maybe that's debatable. Pensions, stocks, those kind of things. And then the orange represents alternative investments. So the lower net worth category has a smaller percent of alternative assets as an allocation of their net worth and their investment portfolio. And in the middle, that represents a net worth of $500,000 to $10 million. And so you can kind of see they start getting more orange in their stack, and those are the alternative investments. And then the category of ultra rich, now I didn't make up these categories, net worth of 10 million or more, they have an even higher percent of alternative investments. And so that's private equity, real estate, and some other things that we're going to talk about. So when I saw this, I started shifting. I said, okay, my house is not an asset. I'm going to have less of my net worth tied up in my house. So we shifted some things like that. We shifted money in our retirement accounts versus money in cash flow investments, and we really shifted. And so I also said, well, what are besides growing wealth, what are the other family office portfolio goals when they're deciding their percents and their allocation? And so these are some of the high points that I've tried to mimic my portfolio to be in alignment as well. So adjust the exposure to risk. So you want to have assets that have uncorrelated risk. So if all of my investments have, these 3 risks, and one of the risks is debt. That if the debt market goes crazy, all these assets that I have will be in trouble. That means that that portion of my portfolio, the risk is correlated. And so one thing can go wrong that affects my entire portfolio, even though I think I'm diversified because I'm in all kinds of different real estate or different real estate markets. If the changing debt market affects my whole portfolio, I'm putting my net worth at risk. So I was very guilty of that. I was like, ooh, I need to diversify on risk. So I was like, okay, I'm looking at my percents, pulling some out of real estate, going into assets that are unleveraged, so investments that don't have debt. So you want some of each, because debt helps you acquire more and grow your net worth for sure. I'm definitely not saying debt is bad. We have tons of debt, tons of leverage on our investments, and it's a very good thing. But I also wanted a large portion of my portfolio to not be at risk, or to be unleveraged, to have unleveraged investments. So I started making that shift. And then something else is, so in times of calm, peace economy, certain investments thrive. And then in times of volatility, where the economy is going crazy, other investments thrive. And so I didn't really think about that when I started investing. But then when my peaceful investments, which I categorized as apartment complexes, became more volatile, I was like, oh, okay, I need to have something in my portfolio that benefits from volatility and volume of these trades that are going on, or volume of volatility. And so I started adding some of that to my portfolio, and I'll say in a minute what that is. And then also the family offices, the uber wealthy, they definitely have in their investment portfolio assets that the government influences. So assets that the government wants you to invest in, because those are the assets that give you a large tax benefit. Either reduces your taxes completely, like gets rid of a chunk of it, or defers it 5, 10, 20 years down the line. And so family offices, they do a huge amount of tax planning, right? So that category of grow more, keep more, this bottom line helps the keep more category. And so I really am diligent about looking at investments and assets and how they tie into my tax strategy. Because if I can defer $100,000 of taxes instead of paying it this year, if I have to pay that $100,000 in 5 years from now, I can take that $100,000 and double it in 5 years. Then I keep 100 and pay 100 in taxes at that point in time. So it's definitely beneficial to save as much as I can today, even if it's deferred. So what falls into this category? So real estate is a big one that probably most of you know about. Also, charitable giving, the agriculture industry, so food, and then the energy industry. There's a bunch there. So investing in all 3 of those can be a play that you do in your portfolio to minimize taxes. And we do that with our clients, with our investors in our community. So this is some homework I think would be really fun for you to do, to go and look at what are your ratios. So take a look at, the chart that I had with the red and green, and then do something like that for yourself. So for me, this is what I looked at. It was like last summer, and I went, ooh, okay. So multifamily, GP, and LP. So that's apartment buildings. And so I went, oh no, I had 82% of my net worth in apartment buildings. I am way too skewed in an asset class that, even though they're across operators, across markets, some are in Dallas, some are in Alabama, some are in Florida. So I thought I was diversified, but really, when the debt market went crazy, when property taxes went up, when insurance went up on all of these by 3x, all of those, no matter what market they were in, cash flow stopped. So I was like, oh, okay. Yeah, I'm definitely too concentrated in an asset class that has correlated risk, 82% of my net worth. Boom, I need to change that. And then these were the categories in, the percents we had in other areas. So these areas, different asset classes are going to be different for you, but I think it's good to put it on paper and see how balanced or unbalanced are you, and are you too leveraged? Because even though it's 42 and 40, those have the same risks. Angel investing has a different set of risks that are not the same as apartment complexes. So seeing, do you have a balance that's uncorrelated and gives you some tax benefits? So that would last, like a year ago. And so since then, I should have a slide now what we look like, but we have shifted. So we've moved, we sold some of the apartments, we moved money into oil and gas for the tax benefit. We moved a lot more money into algorithmic trading, into Forex and gold, and we have trading going on in those areas. Trading that benefits from volatility and volume, like I was saying, like, okay, this used to be a peaceful investment, it's no longer. And so now we have some stuff in investments that benefit from the volatility we're seeing today. When volatility is high, it makes a lot of money. When it's low, it doesn't. But then this over here makes money. And so overall, you can have a portfolio that continues to grow your net worth, whether things are volatile or not volatile. All right, so what I had up there were things that I found interesting to myself. They're going to be different asset classes for everyone. So how do you determine what kind of investing is right for you? So these are the four when I boil it down and I speak to investors. So one year, this was 2 years ago now, I had 700 one-on-one 4-point consultations with investors. I didn't count and tally up what it was in 2023. So those were 2022 numbers. And so the email that you're going to get on Monday for 3 days is basically boiling down 4 steps you can take to grow your wealth. And it was developed from those 700 one-on-one consultations because I couldn't continue growing that. I didn't have more time to do 2,000, 3,000 of those. But it boils down to this first step with all the investors I talked to, whether they had 50,000 to invest or whether they had 5 million to invest. Is that first you need to set a vision. Why are you investing? Do you want passive income? Are you building your net worth? And then level of effort. So do you want to be active or passive? And I'm going to talk about some passive structures later. Risk. Are you more risk averse? Are you still earning income? Can you be more risky? Or are you done earning income? So you should be less risky. And then really set your goals in terms of numbers. Like I want to double my net worth in 5 years. I want to triple my passive income in 2 years. You need to be that specific in order to get there. So now I'm going to show some numbers. So mandatory disclaimer, this is not an offer of any investments. I'm just going to show you what I've seen in my personal investing as far as numbers and say there are risks associated with all types of investing, including principal loss, no matter what you're investing in. All right, so these are all the areas that I've invested. And if this is interesting to you, again, I think it's Tuesday, you'll get an email and I go through these one at a time and explain each of these. But I think it would be good for you, this is what I did for myself, to take everything that you're interested and put it up together. So you want to know, what is the cash flow? What is the annualized return? What's the level of effort? What's the level of risk? How much money do I need to get started? What's the hold period? Is it liquid or not liquid? In this last category, is there a tax benefit? And what is the tax benefit for? So some real estate, you invest in it and you can get a tax benefit against your passive income that you have for that year or carry it forward. Some investments like energy, you can invest in it and you can have a tax benefit. You can defer your income taxes from your active income. So from W-2 or some IRA conversions, any active income, if you invest in energy, you can use that tax benefit, that tax deferral benefit with your total income, your total taxable income for that year. So really knowing, here's the suite of what I'm going to learn about, and then compare them and pick out what you're going to take action on. So for me, these 4 boxes are what I am most heavily in. I'm a little bit in other things, but really I am most heavily in these things. And so that's what Sugo Capital does, is we create a fund around all of these things and offer it to our community because that's what we're experts in. So if you want to put all your eggs in a basket that you don't see on the screen, then you wouldn't be working with us because we don't have that to offer. But it's still a great process to go through with you and whoever you make investment decisions with. Okay, so I want to see real quick, what I'm going to explain next is a multifamily syndication. And it's the same thing for, so if you know what a syndication is, put that's a long word. Yep, put syndication in the chat. Yeah, there you go. Or an abbreviation, SYND. Perfect. Put that in the chat. I want to see how many people are familiar with this structure. And also the structure I'm going to talk about is for multifamily, even though it can be applied to anything. It can be applied to storage units. It can be applied to an oil and gas fund. It's a structure for a fund, a structure for any investment. So basically what it is, okay, great. A lot of people know, so I'll go quick. It's basically pooling people's money together in order to make an investment, but there's a structure to it. So say we want, that really puts the investors at a lower level of risk and a way lower level of effort. So if on the following, when you're setting your goals, if you said, hey, I want low level of effort, I want to be hands-off, then this is going to be really interesting to you. It's going to be in your investment portfolio going forward. So you want to buy this apartment complex. So say it's $1 million, but you need $300,000 to put as a down payment. So I could do that myself, a few times. But then what? I want to acquire more. So if I want to acquire more beyond what I have the funds for, I go out to investors like yourself and I say, hey, we want to buy our 37th apartment complex. Here's our track record. And, we're raising 300,000. We raise more like 20 million at a time, but this is just really easy numbers. And so the way that we structure it is there's two groups that get involved. And this is the same for a fund or any type of passive investment, where there's going to be the general partners. And so they're going to represent the orange on here. And there's going to be limited partners represented by green pieces of pie on the chart I'm going to show. So me, I'm the general partner on our funds, and then limited partners, green, that's folks like you. So what we do is we go out and we say, okay, we need $1 million. Well, we're going to get some debt. And who signs on the debt? Me and my partners. We take on the debt. And then we need down payment. So we go out to investors and say, hey, we need some capital. So here's basically how the capital, where it comes from in order to make this purchase. So then what we do is then we assign ownership. And you can see the ownership pieces of pie are not equal to the capital pieces of pie. So we assign 70% of the ownership of the assets in the fund, no matter what they are. And, different people do it different ways, but generally speaking, 30% of ownership is given to the folks who provided 30% of the capital. So the cool thing about this is that through the value add, as we're making money, increasing the net operating income and exiting, investors get appreciation on 70% of the asset. So that's how they can really make money at the exit. All right. So I'm going to skip through since a bunch of you said, I'm looking at your things. You said what the terminology is. So I'm going to give an example. We're going to run through 2 examples, and then we'll go to Q&A. So two examples of what it looks like to invest in something like this. So say there was an investment, and I'm not saying this is an investment, but say you are looking at a passive investment and it has this information that a general partner gives to you and says, hey, would you like to invest in my thing? Here's information on it. How would you take this? What does it mean to you? So targeted cash on cash return, 8%, annualized return, 20%. It's a value add, meaning taking something and making it better. Some are new development, meaning it's dirt, it's land, we're going to build something on it. Accredited investor, so that means your net worth, not including your home, is $1 million, or you make $200,000 or more per year. Targeted investment period. This is really important as a passive investor because your money goes into a project and you can't take it out. It's not liquid. Some hedge funds might have a liquidity within 1 year. We have one of those where it's locked up for 1 year, but you can take it out afterwards. So that hold period as a passive investor is super important because you don't want to put, this is my nest egg for my kid's college in 2 years, and you put it into a 5-year hold and then you can't get it out. So pay attention to that. So what would it look like? So say you put $100,000 into what was on the screen ahead of you, the previous screen. So 8% a year over a 5-year hold. So 5 years is represented, 8% each year on $1,000. Sorry, on $100,000, that's $8,000 each year. So that's the cash flow. That's the cash on cash that you would receive. And so it may be paid monthly or quarterly, depending on the investment. But basically, you would earn $40,000 over those 5 years in cash flow. Okay, so if you said cash flow is your priority, you would want to look on that cash on cash number as your priority. Now, what it said on that slide is a 20% annualized return. So where does that come in? Well, when the property is sold at the end of 5 years, investors get a check. They get proceeds from sale. So in this example, investors would get a check for $60,000, proceeds from sale, plus their principal investment returned. Now, this is also something to pay attention to. Someone was asking about ATMs and wanted to hear about that investment. So at the end of that investment with ATMs, you don't get your principal returned. So always pay attention. Do you get a set of returns and principal at the back end? You want to know that. Okay, so what have you done? You've gotten $40,000 in cash flow, $60,000 in capital gains that you've earned. So another $60,000 that you earned from this investment. So if you add all that up and you had your principal investment returned, you've turned your $100,000 into $200,000. Now, there's going to be taxes involved, and you can invest with all different trust, LLC, IRA structures. So I didn't include that, but that's going to be something you need to learn about for your situation. But I wanted to give an example of how this looks. Now, finding the money to invest, some of you might say, well, I have some cash in my savings I could invest. And some of you might say, I don't have cash in my savings, so I probably can't invest. But that's not true. There's other areas you can find money. Self-directed IRAs, like Karin talked about yesterday, and 401ks. So part of my homework yesterday is, hey, go back, look at your IRAs and your 401ks. How much is in there? Hopefully nothing's sitting in cash uninvested. And how much is it earning? So I'd love to know if you guys want to put in the chat, if you're open to sharing, how many were receiving single-digit returns in their IRAs or their solo 401ks, or their 401ks even. Just put single in the chat. And then anyone who went back and looked at that and they said, overall in my accounts, I'm earning double digits returns. I'd like you to put double in the chat and then dash what you're investing in. So like double dash real estate, double dash crypto, double dash Forex, whatever it is. Okay, awesome. So double has real estate, IUL life. Okay, great. And a lot of people have single. Double energy. Oh, good. Good, good. Double syndications. Double REITs. So REITs are like a syndication, but public instead of private. Some people in private lending, yeah, that can be double syndication. Okay, great. So I want you to see that, to see people who are getting double digits in their accounts. Where are they putting it? Syndications, real estate, that sort of thing. You can also use a 1031 exchange, sell some property you have. So say you're managing something and you want to go from active to passive, like sell this off. I want to give my money to someone else and retire. You can do that into our investments. And then what Brent talked about was, hey, I have a line of credit or cash value life insurance that I can pull money from and make an investment. So Brent had way more complex and thorough examples, but I want to give a really simple example of if you have a line of credit or you're borrowing from your whole life, and say your yearly interest that you have to pay on it is 5%. What would that look like if you borrowed some money and then made an investment into the example that I showed? So say you have to pay $5,000 a year on an interest-only line of credit that you have. Okay, and then you receive the $8,000 per year from your investment. Okay, so what's your net cash flow? It's $3,000 a year. Okay, definitely this is not a good plan. If cash flow is your priority, you're not going to do this. This is not worth your time, right? However, if you put it in an investment that you can make it cash flow neutral or a little bit cash flow positive to be less risky, but really the majority of what you get paid is on the back end. So for instance, this example where you got $60,000 at the exit of the real estate, that could be worth it then, right? So you're going to get your principal back from the investment, but you're going to take that 100,000 and you're going to go pay off your line of credit. You're not going to keep it. So in this example, you have your 15,000 of cash flow. Okay, who cares over 5 years? But you get a $60,000 lump at the end. So what you've done is you've borrowed $100,000 and you've earned $75,000 on it. So I was like, oh, okay, that's pretty simple. That's worth it. So I encourage you to take a look at what options you might have to do this. So once we started learning this strategy, we really amplified our net worth and we amplified our cash flow because we were able to borrow low and invest in higher yield things. So this is a great strategy. And some folks touched on it, and be in contact with them to learn more about that. And if you're taking a look at all of this and you are like, well, that all looks great, but I don't know exactly how it all works for different investments. If you do is take out your phone right now and you open the camera and you open it up on the screen and you take a picture of this. There's a little link that pops up from your QR code. You click on it. You can download this ROI calculator. And so what it is you can put in the green boxes, you can put the amount of money you'd like to invest in different categories, and it will show you over 5 years, what would that look like in terms of tax deferral, in terms of cash flow, in terms of net yield. So when we get on investment calls with investors, I will pull this up and I will put in different numbers for them. With our investments, you can change the numbers to be other things that you invest in. But what we have on there is, it represents our investments. So people can put a different amount in different categories and see, okay, in total, which is at the bottom, combined investment portfolio, that pink line is the cash flow that this investor would receive. The blue box is the total capital gains that they would receive at the end of 5 years. And then the yellow box is what they've turned their money into. So this example, this investor, they invested 1.425 million with us, with the target of in 5 years turning that into 3.482 million. So this is a great tool. And again, you can change it for other investments you're looking at. And if you want it, you just use the QR code, take out your phone, the camera, and it links you to it and you can download it. So I hope that's really helpful. Most investors say that's super helpful. Now, due to time, and I know Brent's going to come back so we can do Q&A, I'm going to skip pretty quickly through this, but this is the K1. So this is an example of when you invest in real estate, a tax benefit you can get. And this is if you invest in energy. So I'm going to skip through. If this is interesting, you can go back and learn more about this. So I'm going to talk about what's next. What's next after this event? So what's next after today is tomorrow. On Friday, we still have 2 great speakers. We have John Heyer talking about tax strategy. And then we also have Don Pendleton talking about asset protection. They are phenomenal speakers. You guys will love them. So if you loved Brent today, you're going to love the people tomorrow. Lots of content in a short amount of time and an ability to continue to learn for free with them if that works for you. And then from me, you're going to get an email from me Monday, Tuesday, and Wednesday next week. And it's going to have a lot of information and recordings. And I call it my 3 days to financial freedom because it's really, I've been doing this education for 4 years and I've condensed what is most valuable to investors into that material. And so that it's quick and digestible. And so I'm taking what enabled me to quit my 9-to-5 job by the time I was 40, that allowed me to live more luxuriously by gifts for my family members. And best of all, has allowed me to offer passive investments to my clients and retire them. And there's not a one size fits all when it comes to investing. So that's why you need to continue to learn more. And I'm providing this to you as, taking the fast lane. Because like I said, I want you guys to go faster than I did. So that series that comes out tomorrow, it's a 4-step investment plan. And so here's some comments from people who went through it in the early days. And this is how I knew, okay, I need to make this really available to people. So this is Lisa who said, we are still so excited, mind blown that we just went for it, made some amazing decisions based on what we learned, and our future is truly changed. These kind of things, they make it totally worth it. And again, I want you to take the fast lane, not the slow lane. So that's why we're sharing this all with you. Tim, he said, we've already changed our wealth building for the positive with our connection to you. They went through the material. They made a ton of investments that were fabulous for them. And this one makes me most proud. This is from Tom. He said, I credit you in getting me over the hump to actually start making progress on some of the things I've been thinking about for years. For me, I was like, yes, because that was me, where I was learning for 5 years. And then I had an event that was the catalyst. And then I started taking action. But it took me 5 years to get over the hump. So the fact that I helped someone else get over the hump, I was like, yes, we can learn and learn and learn, and then take action is most important. So that series that comes out next week is going to help you take action and really help if you'd like to work with us going forward. And again, we don't sell any courses or education. Everything's free, but we do have investments going forward. So again, that'll be coming out Monday. So keep an eye on your email and always give me feedback. We have a team that hears all your emails, all your comments, and so we'd love to get those. All right. With that, we're going to open it up to Q&A. Brent, you can come back on, and I see a bunch of stuff in the Q&A, so we'll start with that. So I was not watching. I was trying to go as fast as possible. So I was not watching the chat. So if you had a question in chat that was not answered, move it over to Q&A. So we're going to pull up the Q&A right now, and Brent and I will go through it. If you're like, hey, I asked something in chat, you're not getting to it, go move it over to the Q&A. We're going to go through that. All right, we're going to start with a question for you, Brent. This is from Brad. He says, do you recommend having both if my IUL is existing, or transfer to just whole life? So IUL and whole life, or just one? What do you think?
Yeah, so anyway, there's a lot of people that do have IUL policies, and depending on what your IUL is doing, most people are not happy with the performance of an IUL policy because of the growth. There's no guaranteed growth in a policy. As a matter of fact, the thing you can do is take your IUL illustration and you can look at it. And so after you become a certain age, the cash value can go all the way down to zero. The death benefit can go to zero. The loan availability can go to zero. That can never happen in a whole life policy. Now, again, all right, so I'm not here to tell you that your IUL is bad. As a matter of fact, if you go to our website or if you send me an email and say, hey, Brent, I'd like to see the comparisons or the differences between IUL and whole life, we've got lots of videos out there that will go through that. Now, so like as far as me, I would never personally sell you an IUL policy because I would never buy one myself. So if I wouldn't buy one, I would never sell one because, again, our team talks to clients as far as probably every week or every month of people that have taken a bloodbath. So in their IUL policies. So the thing you got to remember about an IUL policy is that is actually an investment. The definition of an investment is the investment can go up and it can go down. So you can make money and you can also lose money. In a whole life policy, you can never, ever lose money because that policy has guaranteed cash value growth, meaning your cash value is guaranteed to increase and your death benefit is also guaranteed to increase, which in tune would mean you would have additional money to borrow or to lend. So I hope that helps. Oh, well, here, actually, I'll add one other thing. So anyway, the thing a lot of people do is that they will do what they call a 1035 exchange on an IUL policy. It's almost like a 1031 exchange if you're buying real estate. This is a 1035 exchange, okay? So after we review your IUL policy, the thing we'll do is just give you the good, the bad, and the ugly on it. And then you make the decision of what you want to do with it. But even if you have an IUL, it doesn't mean that it's okay that that's bad, and it doesn't mean you can't still buy a whole life policy. But that 1035 exchange will take all of the current cash value in the IUL, and it'll move it into the whole life policy. But I never, ever, ever, ever do I recommend you to cancel or kill a policy until you have something new in place. because you never want to leave the family unprotected.
Got it. We have someone asking, I'm a new agent. Is your policy proprietary with your company?
No. So like, so the only thing that's proprietary is our information, that our spreadsheets and stuff we teach,
Okay.
right? I'm not sharing that with as far as other agencies, but yeah. So the thing you do, if all right, so like, okay, for example, the thing is, I'm gonna say that you decide to work with us here at the Money Multiplier. I design your policy the same way I design mine. There's no secret sauce I put on mine that I don't put on yours. Okay. So I am okay, the thing I am is an insurance agent. I'm a producer. I'm what they call a general agent. So the policy that you buy, if you're working with me, it doesn't come from Brent Kesler Insurance Company. I am the agent, and I write with like 5 different companies. And these companies are all companies that are mutually owned companies. And so the product is a whole life policy in a mutual company that's specifically designed and specially engineered for high immediate cash value. And remember, the key word is immediate, which is within 30 days, and high cash value. So if you work with me, I am the agent. Now, the reason you want to work with me and not the guy down the street that sells life insurance, or not even your brother-in-law that sells life insurance, is because the guy down the street or your brother-in-law doesn't understand the banking concept and how to design the policy properly for this concept. And if they do understand, then my question is, why haven't they told you already? Why am I the first one telling you this? So I get paid, and that was another question that I saw in the chat box. Okay, so I get paid one way only. I get paid the same way your car insurance guy or gal gets paid. For example, if you go to John Smith, the Allstate man, to buy car insurance, the check that you write is not to John Smith. You write the check to Allstate, and Allstate pays John Smith a commission. So that's how I get paid. I am licensed in every state of the country. I have over 12,000 plus clients in every state of the country, right? So I can write for anybody in the States, even Canada, even though I'm not licensed in Canada. I have a team in Canada. Okay. If there's people on the call that are from Canada, yes, our team can help you. If you're from, somewhere else, Australia, New Zealand, I can't work with you in Australia or New Zealand unless you have a US or Canadian bank account, and unless you take your paramed, which is your health exam, in the US or Canada. So I get paid a commission on the policy that you start, okay? And the commission that I get paid is not determined by you, the client, and it's not determined by me, the agent. It's determined by the insurance company. But I will tell you that the commission that I take is 60% or greater, smaller amount than the guy down the street. And the reason is because of how we design the policy. We design the policy, as I said earlier, for high immediate cash value, where the majority of these whole life policies that you've heard about in the past, or maybe you currently have them, or people in your family, parents have them. If you notice, there's no cash value in the first year. There's not really any in the second year, and very little in the third year and fourth year. And the reason is because of the design of the policy. The agent is designing them more to focus on the death benefit and not the cash. See, where we focus on the cash value and not the death benefit. As long as I solve your need for cash and finance, you'll have more death benefit than you can ever imagine. So I hope that helps.
And that was so thorough. I went through a lot of the open questions, and I think you covered most everything else. That's awesome. So someone asking about, hey, I might miss part of tomorrow. I really want to hear John Hire. Yes, replays are being sent out. You guys look every afternoon. You'll see the replays. This is a really good question. It's from an anonymous person, but Sarah, do you think timing had a lot to do with your 10xing your net worth? And the answer is yes. It totally did, because I was invested in real estate. I got out of a lot of them in the middle of 2022. We still have a lot of stuff, but that was a time of massive appreciation in real estate because there was a massive increase in rents, especially in the markets we were in. And so we were able to sell at a very nice profit for us and for our investors. However, it's not to say, oh, that was just because of your timing. Everything is because of timing. So why did we only acquire like 30%? Our volume in 2023 was 30% of what we acquired in 2022. We drastically scaled down because it was not the right time to be massive in real estate. Had to be really picky and much, much more conservative. So timing definitely had a lot to do with the 10x in my net worth. And you have to always pay attention to timing. So when I was talking about how to balance your portfolio, that's exactly why we're not 10xing in real estate. We're doing more in real estate for sure, but we are also doing a lot in Forex and gold because there's a lot of volume. There's a lot of volatility in markets that are public markets that are trading. So we're getting in there and making money over there. And so we're seeing, okay, timing. We always have to know timing of the different areas that we're an expert in so that when it's a good time to go gangbusters in real estate, we can. And when it's a good time to go gangbusters in investment B, that is, great when there's all this volatility going on, then we go gangbusters in that. And when it's a great time to, sell Bitcoin, buy Bitcoin, whatever it is, I'm not in that, but you need to know timing. So timing is totally relevant, and that's always the case. So you need to learn about timing and make sure you pay attention to it. The answer is yes, and it's always going to be yes. Timing of losses. It's like, oh man, I wouldn't have lost so much money, if I didn't have this huge over-leveraged single-family home portfolio in 2008. A lot of people say that, and that's timing. If they had that in 2021 and 22, they would have made a lot of money. So you got to look at all the levers, the economics, and what's going up and down, and how does that affect what you're invested in, and do you need to leave that asset class for a while and come back later? You always need to know that for yourself. All right, here's a question from Sue. Thank you, Sue. If we pay off a rental property mortgage, do you know if the payments to life insurance loan are tax deductible against your rental income? Brent.
Yeah, well, and again, I'm not an accountant, I'm not a CPA, so I'm not going to tell you what's tax deductible or not, but let me just tell you what I do in my own life, because I use my money in the policy to do these investments, to do real estate. I do a lot of lending. So all the dollars that go into the life policy are going in with after-tax dollars. Remember I said earlier, pay tax on your money one time only, get it into a tax-free growth environment, and get the government completely out of your hair. Anytime you take a policy loan, the key word is loan, not a withdrawal. When you take a policy loan, a loan is never taxable. I mean, just think about it. Have you ever paid tax on a loan ever? No. Now, if you took a withdrawal from the policy, then that would then again that could create a tax liability if you withdraw above and beyond the cost basis that you put in the policy. But I can't even tell you any clients that we have that take withdrawals. They take policy loans, right? So the thing you're doing is you're taking a policy loan, and then the thing you're doing is you're taking that loan from the general fund of the insurance company. So you're borrowing from the general fund, but the thing you got to remember is what that means is that all the money in your policy is still in there. It's still in the policy. So all that money is still growing tax-free in that environment. It's still continuing to grow even though you're using the money. So how cool is that? You're using your money and your money is continuing to grow. I don't know of another vehicle on this planet that allows you to do that with these features and benefits. Now, from my understanding and from my tax professionals that as far as that I deal with, is that if you are going to use a policy loan for a business purpose, then yes, that can be okay. Then, so the interest portion that you're paying is tax deductible. But I'm not an accountant, I'm not a CPA, so you got to see what your own specific is, right? As far as what you're doing specifically, and ask your accountant or tax professional. And if your accountant or tax professional is giving you an answer that doesn't seem appropriate, then you may want to go find another opinion or a third opinion or a fourth opinion. But if you're like going to use the money for a business purpose, then maybe that loan interest should be tax deductible. It would be the same thing if I'm a chiropractor and I buy a new x-ray machine and I take a loan from XYZ x-ray company to buy that x-ray machine and I have to pay interest on that loan. Is that a tax deductible expense? I mean, it has been with every x-ray machine that I purchase. So if I'm going to borrow the money from my business to buy a piece of real estate, should that interest I pay be tax deductible? So I'll let you read between the lines there.
All right, thanks for that. We still have 30 questions in 1 minute, so I'm going to try to do a speed round. I'm going to pick out everything I see that's for me. Sarah mentioned an event coming up. So there's tomorrow is the third day of this event, and then next week you'll receive emails from me about a 3-day challenge with some information. If you're interested in investing in multifamily, I see some of you saying that, you can email hello@sugilcapital.com. Also, you're now on my email list, so you'll get an email from me, but feel free to be proactive. Stacy, it would be great if you reached out to Irene Hicks. Looks like she's interested. Smaller investors. So say you don't have $100,000 to invest. You want to start with 5 or 10. Google crowdfunding platforms. And there are a bunch out there that take 1,000, 5,000 as their minimum investments. And it's a crowdfunding platform. So you can just Google it. In the example that I showed, someone's asking that 60K payout after 5 years. Am I correct to say it's a risk? Like if the property doesn't sell in 5 years, is that a risk? Yep. I would say it's a risk. With all investments, there are a risk. Cash flow is a risk, and payout at the end of it is a risk. So you just have to make sure that it fits. Is it high or low risk to you, depending on the team, depending on the market, and all that other stuff. And if you're not sure how to do due diligence, again, Tuesday, you'll get an email from me and it has links to material. And so I go really deep into how to do due diligence on a team and a market so that you can feel comfortable choosing something that's, has a risk level that's appropriate for you. Fees for your syndication, Sarah. Yep, each one's a little bit different, but usually it's a 3% acquisition fee. And then the equity split is around 70-30, but you're going to want to take a look for each one. Now, all the returns that are the target returns shown to investors are net of fees. So the fees are not on top of that. It's not paid out from what you see. What you see is what you should expect to get. Do all the GPs you work with on multifamily do catch up on cash returns for LPs? Yes. Questions about accredited investor. Google accredited investor and you will find more than enough information. Hi, TARDIS clients who are saying hello. Questions about commission you already answered. Dan and Stacy, I think you should talk. So Stacy, if you want to reach out and talk to Dan Lunecki, that seems good. How does Sugo and TARDIS different? And does what Brent does fit with TARDIS? Great, this is perfect. So all these speakers, how do you guys all fit together? So Brent is not offering investments. He's not an investment advisor. But what he does fits into the TARDIS model. So yesterday, if you missed it, go listen to the recording. Tanisha talked about how you could use borrowing from your policy in order to be the leverage you need to invest with investments like Sugo in order to make the snowball with TARDIS work. So it's all interrelated. Feel free. Some people are asking, hey, can you go back over that piece of it? That's why we're recording. So we'll send it out. You can take notes, pause where you need to, take screenshots where you need to, talk to someone else about it so you can really make sure you understand it. But yeah, TARDIS does not have investments. TARDIS teaches a strategy of borrowing here and investing here, and they're agnostic about where you borrow from or where you invest in order to create passive income from yourself. So Brent provides the borrow bucket, and I provide the investment bucket. And so you have to see what fits and what works for you. How do you invest in oil? There's tons of oil and gas investments out there. We're doing some due diligence. We might offer something in Q3. But if you want it earlier than that, you could do some Googling around. Oh yeah, here's a good clarification. Do I do wealth planning? No. So everything that I'm talking about planning your portfolio, it's not, we're not wealth planners or wealth advisors or anything like that. We don't charge for our time or tell you here's what you should invest. But we tell you if this is your priority, we have an investment for you. So that's the difference. Tardis doesn't have investments, Sugo does. And we don't get paid for anything except from the investments that you invest in. And only if they do well. So you get paid on the back end with you guys. All right. Now there's some more questions about specific returns. If you guys go to sugocapital.com/open, on that page, we have our open investment opportunities. So I see some questions about Forex. You can go see it in our investor portal. So sugocapital.com/Forex, and you can see information about our Forex fund in the portal. Oh, this is interesting. So this is from Ryan for you, Brent. What is your ongoing meeting rhythm with clients after they place a policy?
Great question. And that's what makes us unique and different. That's why you want to work with us and not the guy down the street, because it's not about you starting the policy. It's very easy for you to go out there and find somebody and start the policy with them. That's the easy part. The challenging part comes in after your policy is started. How is that policy just going to be used and implemented? Because as an insurance agent, it doesn't matter if you okay, when you start a policy, the thing you can do is you can choose to pay your premium however you want. You can pay it monthly, quarterly, twice a year, annually. You can always lower the premium. You can always change the mode of how you're paying the premium. But the majority of the time, the majority of agents, after you start the policy, they're done and they move on to the next client, right? Because they've already just have the policy, they collect commission. Of course, it's ongoing commission, right? Because it's not just one-time commission. The insurance agent gets renewal commissions over and over, year after year, but the renewals are way lower commission than they are the first year. So what incentive does the agent really have to continue to work with you and not go just and get more clients? Well, that's what makes us different. I have a complete team, and we call them the I team. It's the implementation team. Now, today on my presentation, if you noticed, I just hit on it really briefly. It was called the Money Multiplier Map. I didn't have a chance to go through it all, but when you go watch my recorded presentation, the thing you'll see is that Money Multiplier Map. And the thing that the implementation team is going to do is they are going to create you your own specific money multiplier map, and also additional policy tools such as your cash flow analysis, etc. Right? That team does that for you. So it's not just one time that they do it. They're going to update that map for you 2 to 3 times a year, every 4 to 6 months, or anytime that you have a significant purchase or there's something significant that you sell. Like if you buy a house, sell a house, buy a car, sell a car, they're going to update that map for you, because what's going on in your financial life is not stagnant, right? Because the thing I want you to think about is, all right, go back 5 years ago, 10 years ago. Has your financial life changed 5 years ago and 10 years ago? Yes, and it's constantly changing, and it's going to continue to change because you buy things, sell things. You have windfalls and downfalls. You get raises and demotions. So our team actually is updating your financial tools, your policy tools on an ongoing basis, and you never pay for that service. That is a service that we provide for you. As I said earlier, you're never going to write me, Brent Kesler, or our company, the Money Multiplier, a check for a dime. I get paid one way only, a commission from the insurance company. So we are constantly providing you these services, and you're never paying for those. So they're always available and they never, ever stop.
And I want to say two things, you guys. You want to work with someone who's transparent. And Brent was just very transparent about how he gets paid. And you want to know when you're working with someone where they get paid. I mean, it's great. A lot of people are not that transparent. So I love Brent's transparency. And then also look in the chat. There is a lot. There's Byron who said the Money Multiplier team support is excellent. Support has been amazing. People have so many good things to say about Brent's company who are current clients. So that's a lot of social proof for you guys.
And then also, Sarah, just if I can add, like if you go to our website, themoneymultiplier.com, we've got 70 plus videos out there, lots of resources. Or again, I'm always open to email me. I mean, if you email me stuff, I'll get you the answer. I may not be the one to give you the answer, but I'll send you a resource of where you can find it, or connect you with a mentor on our team, a money mentor on our team, or even if you just want to do a strategy call with them and ask them, like go through your laundry list of questions. And again, it's not just a one-time thing, right? So this is a relationship building event, where it's constantly, you're constantly going to have questions. You're going to have things that come in your mind you're not thinking of today, but you'll think of tomorrow. So that's part of what makes us unique and different, is our service and our ongoing content that we put out there. And also, I love it when the clients bring questions, because again, so all right, so like I know my daughter had to get off to go on another call at the top of the hour, but so about every question you guys ask, we usually create a podcast or some kind of content or a video that you can go watch that will answer that question. We have hundreds of those out there.
Awesome. I love it. And I think that will be the last question we answer. And taking a look at the open questions, there are so many people asking, hey, do you recommend this or that? And if someone came to me and said, hey, do you recommend multifamily or a Forex fund? There's a lot more I need to know about you before I would make that recommendation. And it's the same for Brent and his team. They need to know more about you before they can say, hey, I'd recommend this or that. So I encourage you all, you have all the information on how to get in touch with Brent, how to get in touch with me, how to get in touch with our teams. So these are fantastic questions. And in order to give you the best answer for yourself, please contact us. We're here. And we'll go through, get some more information about you, and then we'll give our advice that'll be much more accurate once we know more about you. So Brent, thank you so much for being here. I truly appreciate it. I'm looking forward to doing more with your company, and next time with your daughter, that'll be really fun. And everyone, we will see you tomorrow. I am so excited. We have 2 more speakers, tax, asset protection. You need to know it. And they're fantastic speakers. Brent, again, thank you, and have a wonderful day, everyone.
So thank you, Sarah, for having me. Great to be on.